You want to understand the oil market? Core Labs told you everything you need to know when it slashed its dividend from 55 cents to 25 cents on the last day of the year. Don't know Core? It's perhaps the most sophisticated oil service company out there. Their technology helps producers find oil and get the most out of their reservoirs. As the price of crude rises, the services become more and more valuable. So with oil going up rather nicely, at least until today's brutal reversal, how's business? Frankly, it's the worst I've ever seen it. Even worse than January of 2016, when oil briefly traded below $30 a barrel, less than half of where it is right now. What makes me say that? Okay, Core has been on Mad Money many times. It's a very thoughtful company. They make their decisions based on traditional metrics like their return on equity, not pie-in-the-sky forecasts of drill, baby, drill. For years, their dividend has been sacrosanct. Management wouldn't cut it unless they had some serious long-term concerns that the oil industry just isn't coming back in the way it's supposed to when the price of crude goes higher. The news was shocking, devastating. Core only cut its earnings forecast for the latest quarter by roughly 15%, yet they cut their dividend by nearly 55%? That doesn't make any sense unless management has come to the conclusion that the oil business has fundamentally changed. At first glance, Core's explanation seemed innocuous. Quote, the decline in U.S. onshore activity has proven to be more pronounced than originally forecast in Core Lab's third quarter earnings release from October 23rd. Okay. But in many ways, it speaks incredibly loudly. Despite an uncertain world where the Strait of Hormuz could be shut down by Iran at any time, a world where international oil producers have let their wells run down drastically, drilling just isn't picking up. In fact, if you look at the Baker Hughes land rotary rig count, my favorite indicator of drilling demand in this country, it's actually collapsing. A year ago, there were 1,050 rigs operating on land in this country. Now there's 773. That's staggering, right? Especially when you consider that oil was $52 last year, $8 lower than it is now. By the way, that's why the stock market refuses to really freak out about Iran these days. Investors sell stocks off tension in the Middle East because historically it causes oil prices to spike big. That raw cost inflation then can devastate the economy, at least slow it down a lot. Yet that didn't happen this time around. In the scheme of things, oil really has barely budged. Why? Because if you're a huge consumer of petroleum, you know what? You can lock in prices out 5 years that are much lower than the current spot price. It's that bountiful. There are 3 reasons for this. 1, the demand for oil seems to have stopped growing. The world used only 800,000 more barrels per day last year than it did in 2018. Substitution, conservation, preservation, you name it. It's taking its toll on the growth of the industry. 2, we have a tremendous amount of spare capacity in this country, in part because of all the shale finds from the last 15 years, and in part because President Trump has been incredibly pro-oil. That spare capacity means we have a much easier time absorbing supply shocks. 3, technology. The technology of rig development has producers getting a lot more oil per rig. So when tensions flare in the Middle East, that's not enough to send the price of crude surging anymore. American producers can just turn on the spigot. Problem solved. If we didn't see a massive spike after 25 drones blew up half of Saudi Arabia's oil production in September, maybe we can handle it when whole countries go offline for days or even weeks at a time. Plus, it's not just America. The Saudis could easily produce another 1 million barrels a day if they wanted to. The Russians are eating up this blip. They want to encourage it. There's simply oil everywhere and not a drop to drill. When Core Labs, the brains of the oil complex, cut its dividend last week, they were telling you this situation is only going to get worse for the industry, not better. And maybe that's all you need to know. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.